Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 283 for December 7th, 2020. We are recording this at 1 p.m. Eastern Time. My name is David Kosmeter. I'm the creator of TimingResearch.com. And today we're going to be talking about the S&P 500 and whatever else we see going on in the markets this week. So today I've arranged for Sam Bourgi of TradingGods.net to be with us. And it's been a few months since he's been able to join us, so great to have him back. And Jim, the option professor, is here to moderate, so I'm going to go ahead and turn it over to him.
Okay, great. Thanks, David. And welcome, everybody. Sam, for the people that are not familiar with you, could you do just a little background on yourself and a little bit about what the company is doing?
Sure, absolutely. Well, it's great to be here again. I know it's been a few months, as David suggested. So my name is Sam Bourgi. I'm a markets editor for TradingGods.net. My background is mostly on the macro side. Did a lot of economic research, fundamental analysis on various markets tied to stocks, commodities, as well as cryptocurrency. At TradingGods.net, we're focused mainly on the volatility markets, as well as on the S&P 500 and the overall stock market. We're teaching traders, how to learn the ropes and volatility, as well as trading weekly options. So TradingGods.net, you can learn more about that.
Okay. You know, these are two great subjects, obviously, to talk about now, because the S&P obviously just went towards an all-time high above 3,700, and the VIX is near one of its lowest levels since we've had the crash down in the 20 area. And it seems like they're both very much at critical junctures, as far in the short run anyway. But before we get into that, we have some general questions we ask, and I don't know if it's up your alley or not, but the general questions are, between today's open and Friday's close, do you have an opinion on where the S&P might be in this week? Because we did open today on the S&P at, let's see, the cash S&P. Looks like it opened at 36.94. We're currently, a little bit under that. So what do you think between now and Friday, Sam, from the 36.94 number?
Honestly, I share the same view as I think the crowd forecast here. I am expecting it higher. And I guess the next question will be my confidence in that. But yeah, I am expecting it to go higher this week.
Okay. And yeah, your confidence level and any, reasons behind the curtain on why you feel that way.
Yeah, so I mean, my confidence level for this would be 60%. It would be higher given the fact, other than the fact that we may be overextended. But the reason is that you see a lot of the chatter around stimulus talks ramping back up again.
Right.
All the volatility that's declined since the U.S. election back in November, that's kind of subsided. Investors seem to be confident that we're going to have a smooth transition in the White House in January, combined with optimism around the vaccine and just general market sentiment and seasonality. Just leads me to believe that, we could end higher for the week. I'm not expecting huge movements given that, the major economic data releases were last week. But overall, I would say about 60% confident that it's going to go higher this week.
Yeah, more confident than not, basically.
Yes, pretty much.
Yeah. Okay. And again, is there any, or are you just technically oriented, or do you use any fundamentals as well? I mean, what are you thinking on the fund? Oh, you mentioned the stimulus might be passed, and of course that might be a shot in the arm.
Yeah.
What do you think the risk is? It's a buy the rumor, sell the fact, though. What level of risk do you put at that, or percentage?
Yeah, that's always a factor. I look at it from a more macro sense, and I don't see very many downside risks to stocks in general moving forward. If you take a look at all the stimulus talks coming ahead, you take a look at Janet Yellen becoming the new member of the Biden administration. I just see the Fed's going to pump, and the market is going to respond in kind. So overall, I expect that to be intact over the immediate term.
And are you a believer in the animal spirits, meaning people are dying to spend a lot of money, and with the savings at record levels, they have the money to spend? And if you throw stimulus on top of that, you got a trifecta that would be a pretty powerful economic movement in Q1, Q2?
Yeah, absolutely. You take a look at the trillions that have been printed this year. I mean, a lot of it is ending up in the stock market. You take a look at the savings rate. We saw the savings rate rising really high following the pandemic and all the stimulus. So I just think that more of that money is going to trickle into the stock market. We're also seeing it trickle into the cryptocurrency market, which is another sign that, positive sentiment and bullish sentiment is prevailing, and I expect that to continue. Now, What this means in the long term, that's something completely different. But I think in the immediate term, we're going to see more a higher upside.
With regards to crypto, since you mentioned it, when I'm looking at crypto, I always look at GBTC, which is
Yep.
the grayscale Bitcoin, because 4 million shares already traded. It's a liquid situation, and it's a little easier than getting a wallet and all that rest of that stuff. Do you follow GBTC, and do you think is that an apex here temporarily, or do you think
I do follow it closely. The thing with GBTC is what they're doing is they're buying up a massive swath of all the available Bitcoin that's coming into the market every single day. So clearly they're preparing for a massive bull market. We have hit some major resistance in the Bitcoin, and the price of Bitcoin around 19,500. That seems to be a rejection zone right now. But if you take a look at what Grayscale is doing, they are massively accumulating Bitcoin on a daily basis. And that leads me to believe that they are positioning for a large uptrend in Bitcoin in 2021. And that follows, 4-year cycle theories, and it follows, the institutional adoption that we're seeing, as well as the FOMO on the retail side that is slowly creeping back up again. But I think Grayscale is positioning itself for a large uptrend in Bitcoin moving forward.
And you kind of, it's correctly doing that?
I think so. My opinion is that it's going to be much, much higher. If you take a look at just the supply and demand characteristics, there's about 900 Bitcoin being minted every single day, and all of it is being snatched up by PayPal and by Circle. And Grayscale is also accumulating, a few percentage points of the entire Bitcoin supply so far. So another key metric that I do look at is Bitcoin treasuries. You take a look at the number of different companies that are holding Bitcoin on their cash reserves, and MicroStrategy just upped its holdings just last week. So all of these are, there's a confluence of factors that are leading this to move higher, I think.
Now, this Tom Lee of Fundstrat has been saying things about halving, and I'm not that familiar with it, so I'm going to ask you a question. He says that in 2016 there was halving, and then the next year, 2017, it went nuts on the upside. In fact, this Grayscale went to about $40. He said the halving is going on this year, and he's anticipating 2021 to potentially have a nutty move to the upside as well. Explain halving a little bit, and then why it would make it go up. I don't know.
Sure, absolutely. So we had a halving event take place back in May. Basically, Bitcoin is a software protocol. It's every 4 years there's a halving event in which the number of Bitcoin that a miner receives goes down by half. So now what that does is that the supply of Bitcoin then declines by half once the halving event occurs. So that essentially means that fewer Bitcoin are coming into circulation. And that obviously, if demand rises and there's lower supply, that leads prices higher. There have been some astronomical price predictions over the next year or so. Even the likes of Citibank recently forecast, I don't even want to say it because it's kind of embarrassing, but it's like a $318,000 Bitcoin by the end of 2021. There have been several others that are predicted a 6-figure Bitcoin over the next year. Things seem to have changed in the sense that now we have more institutions involved. You've got the Paul Tudor Jones, the Stanley Druckenmiller. You have, JP Morgan, all these different institutions that have spoken favorably of Bitcoin and about the need to diversify and have a hedge against inflation. And Paul Tudor Jones called it the fastest horse in the race against inflation. So I don't know exactly where it's going to go, and there's always risk, but I think the stars seem to be aligning for a massive breakout over the next year. And you take a look at its recent price action, all of this is happening and no one is really that excited. There's not a lot of FOMO going on right now, even though prices have hit all-time highs. So it remains to be seen when the actual retail FOMO kicks in, where it's going to go.
Yeah. The total amount of Bitcoin, I was told in some of the readings I got, is around 300 billion. And then the total amount of gold out there is 10 trillion. So from a standpoint of scarcity, if you did get serious money chasing into Bitcoin, it is, it's a fraction of what's gold got, right?
Absolutely, absolutely. So basically right now, Bitcoin's market cap is around 350 billion. Gold's market cap is around 10 trillion. So the narrative, and now a lot of the Bitcoin proponents, what they say is that, well, Bitcoin has a lot of the characteristics of gold. So there's going to be a chance that Bitcoin takes some of the market share away from gold. How much of that is yet to be seen. But even if Bitcoin manages to take a few percentage points away from gold in terms of market cap, we can see prices go much, much higher. There will only ever be 21 million Bitcoin ever mined, and the last Bitcoin will be mined roughly around 2140 based on current mining trends. So it's a scarce asset, and the idea is that as more institutions and more people get into it, that price is going to go up given the fact that supply has been declining.
Now, since we mentioned the gold, let's just hop over there for a minute, because my belief was that that pullback towards 1775 hit the 1-year moving average, and that might be the pullback bottom. Right now we're at 1869, up 30 bucks an ounce. It's the third biggest holding of central banks, so you certainly can't dismiss it as a barbaric relic. With regards to gold, is it possible the 1775 is the pullback low, and is it possible we have commenced a turn to the upside?
Yeah, I think so too. I mean, for me, that pullback surprised me, just given all the macro factors in play. I expect gold to go much higher, and I think that the all-time high that we saw in pretty much every currency, the last of which being the US dollar, I think that's just a starting point of where gold is going to go over the next few years.
Do you follow the miners like GDX or GDXJ or anything like that?
Not as closely. I mostly follow the futures market on gold and look at the price of spot as well.
And do you have any kind of an opinion on the silver? Because that went down towards 22 and now it's in the 24s. And some people think on a percentage basis, it could be a better deal than the gold.
Yeah, I mean, there seems to be more upside in silver. I think, the two I've noticed have moved in lockstep quite a bit, although silver's gains have been more, a lot bigger, especially this year. So I expect whatever upside we see in gold, I expect the same for silver as well.
And since we're sitting in the metals, some people were telling me that platinum, which is 10 times rarer than gold, may also have a fairly significant move to the upside, maybe as high as 1400 in the short run, because it's made a little bit of a turn. Do you have any feeling on the platinum? It's down today, 23 bucks, but it did have a nice little run from 850 to 1100.
Yeah, I don't follow the platinum market as closely, and if you take a look at the performance year over year, it hasn't performed as well. But I look at how it's rebounded from the March liquidity crisis, and I see, as long as the macro picture favors precious metals and scarcity, I think that platinum will do well as well.
And one last one is in the copper. It had a huge move up here towards 350, I guess, to 355. Is this a time where it may take a break, or because Freeport McMoran, FCX, and some other copper stocks have really been winners this year, but it's come a long way. I mean, is there a 4 number in copper next year?
I think so. I mean, if you take a look at its performance just over the past year, I look at, industrial demand, and you look at copper, and then you take a look at the rebound from the COVID-19 pandemic. And I think that, as long as we're starting to see that the economy rebound, I think that copper will perform well as well. I don't have any price targets, so I don't follow it that closely. I mostly follow the precious metals, but I just see the metals as being something to really keep an eye on as we head into what's going to be a very, very exciting 2021.
Right. Let's turn the table over to the S&P. And, obviously, like I say, we did make an all-time high at 30s. Well, on the cash here, it looks like it never broke 3,700. The futures went above 3,700. But 36.99, I guess, is the high on the S&P. And if you were to think there could be a pullback, what number would get you a little bit more concerned that the pullback might be more significant than people think?
Well, I see a move below 3,600. I know that there was some resistance around that level back in November, but ever since it broke above that, I have been more bullish. But overall, I just, for me, I don't really look at, I'm not a technical trader, so I don't really look at a lot of the technical charts on a day-to-day basis, but I just look at the macro picture for the S&P, and until I see something different, until I see a different narrative around the Fed, around stimulus, I don't see long-term downside. I just see that the animal spirits, as you mentioned earlier, are ramping up again, and I just see the S&P continuing higher in that respect.
So any dip is an opportunity to add?
I think so. I think that's just the way it's been, and you take a look at how it's performed. It's kind of been shocking the way the markets have rebounded from the liquidity crisis of March, even though the economy just barely, scraped out of a recession, and that we still have, really high unemployment claims. We have an economy that's still nowhere near where it was pre-pandemic, but there's more stimulus, there's more money, and a lot more of that is going to be trickling into the stock market.
Well, one thing that Lee got at Fundstrat said a long time ago is that you're going to be shocked how unemployment will stay high. You're going to be shocked at how companies are going to reduce their overhead in employees and in real estate, and how their operating leverage is going to go through the roof, which is going to shock people how the earnings come in, because the earnings maybe on less revenue are actually going to be better because of the operating leverage. Do you kind of follow that theme a little bit?
Yeah, I mean, I've been following a lot of the, this the shift in labor market trends, and you're starting to see it as well in where people choose to live. I just think that what COVID did was it accelerated this digital transformation, that you have more people now working remotely, and a lot of companies realizing that, we don't need all this overhead, we don't need all this massive, office space. So I think that over the long term, that's exactly what's going to happen. And we've seen it initially now with a lot of the tech-focused companies, but I think as this transformation continues, you're going to see more of that, because a lot of people realize, especially if you're a knowledge worker, you probably don't need to go into the office every single day, right? So I think all of that feeds into this shifting narrative towards digitalization, and I think that's going to be reflected in corporate earnings as well.
Now, one of the indicators that Buffett looks at is the GDP divided into the Wilshire 5000, and that number is around 180, which is a very, very high number. And the way some people dismiss that as not a problem is they say that valuations are going to get higher in some of the value stocks and stay high in the tech stocks because of the negative interest rates that we have. When you take the rate of a treasury and then put in the inflation rate, it's negative rates. So with negative rates, the theory is you can forget about the overvaluation argument, because the valuations are going to be extended. Is that your feeling, or what do you feel there?
I think so. I mean, what that means, for the future and the health of the stock market or the health of the dollar, I think that there's a lot of things that are really out of whack now. But if I'm looking at it purely from an investor's perspective, you have, negative real interest rates, and you look at the stock market, I just see that as being a logical place to put your money. And I do think the Buffett indicator is significantly overvalued, and I think it is a reliable indicator. But as you mentioned, there's really not a lot of other places to put your money. So you take, negative interest rates are, they reflect that. So I think that the Buffett indicator isn't as, it's not that sell signal that it would have been in previous years when you look at it right now, with it being 182%, I think. So yeah, I agree with that sentiment. I don't know what that's going to mean in the future, but for the short term, for sure, I think that
it's
there's just not a lot of places to put your money right now, right?
Yeah, it's a back burner deal.
Yeah.
Let's talk about the volatility, which you say you follow quite a bit, because I follow it as well. And I think, like I say, this 20 number is just really important. And I think, my feeling is that if we, and some other people as well, if we do break 20 and sustain it under 20, that is going to possibly really let the floodgates out on this sideline money that's kind of waiting for kind of a notification that we are going to be stable, and that this is not just something that's going to fall apart on them. Because, that's one of the reasons I think there's so much sideline cash is, nobody wants to put a lot of sideline cash in on something where the VIX can go to 40, which it did only a month or so ago. And then find out that they put trillions of dollars into something that's, trading like a commodity.
Yeah.
So, I mean, how do you feel about that VIX? Because it does look like rock solid lows and that 20 number. And today we are at 2174. So,
I mean, as you mentioned, the VIX, does have a tendency to spike. It spiked last month. We saw it hit record highs pretty much back in March. Now, the reality is the VIX right now is, to be honest, it is elevated when you consider the S&P at record highs. Typically, when the S&P is at record highs, the VIX usually isn't above 20. However, given the circumstances that we are in today's market post-COVID, the fact that we've had all these issues with the economy, that we've had all this issue with the pandemic, a VIX at around 20 is pretty bullish at this point, and it peaked around 90 back in March. So we've seen perpetual declines over the past 6 months, with a few intermittent peaks, mostly around election-related volatility, in my opinion, and concern around a vaccine. But now that people seem to have overcome that uncertainty around the vaccine and around the election, and the VIX is right around the historical average of around 20, I think that's a very, very bullish call on the S&P right now as well.
Now, a lot of people talk about pulling forward, and that means that people have bought a lot of stuff that they would have already, that they might have bought down the road. And a lot of purchasing has been done. A lot of bidding up of these stocks has been done in advance, in advance, in advance. And that next year might be a little surprising on how much is left on the table. Do you see any kind of a scenario where we've used up a lot of the gasoline here, or do you think there's plenty more gas in the tank?
Yeah, I think one area we should watch, if that narrative is to play it out, and it could play out. One narrative is to look at is the the explosion in tech stocks that we saw throughout the year. If you take a look at the performance of the S&P 500 and just the broader stock market, it has been driven mainly by these major tech companies. So what I would do is I would look at how they're performing, how the Facebooks, the Amazons, the Googles are performing to get a sense of whether that's the case or not. Because as long as these core FANG stocks and the big tech are performing, I just see the market continuing higher. So that narrative could definitely play out. I would keep my eye on the large cap tech stocks then in that case.
Yeah, now I'm have been noticing that September obviously marked the peak of a lot of the FANG stocks, Microsoft and Apple and Facebook and I don't know, did Amazon peak out at that time as well? I think it was September when it made the highs. Let's see. Yeah, September was the high there too. So, I mean, how important is it that the highs in September have not been taken out by the FANG stocks? And are they telling us anything as far as, is everyone, if people do come back in, are they going to look for the stocks that are at a 15, 16 multiple that pays 2 or 3% dividend and go into that cyclical deal, and they're not going to be as excited about these tech stocks that have gone through the roof because obviously they have been unable to make new highs in 4 months or 3 months?
Yeah, we can definitely see some rotations, and for me, the main ingredient is going to be the stimulus. As long as there's stimulus cash flowing, I think that's going to be a a positive factor on equity valuations. The tech stocks have been the main drivers so far, but I mean that could change. But I would still look for the tech stocks to kind of give me a barometer of where things are going. Even though these stocks have exploded in value, they've also done very well during the pandemic. A lot of the pandemic stocks have performed very well, and a lot of them have been tech stocks. So I would still look at them as kind of a barometer. But as long as that stimulus is flowing, as long as you have trillions coming, and with Yellen at the helm at the Treasury, you're going to see a lot more of that as well. As long as that reality is intact, I just see, it favors more upside, in my opinion.
Yeah. No, and I think, obviously your opinion is well taken because
Yep.
of so many factors that we've already talked about. It's just, I guess, in the short run, or maybe these stocks are just consolidating because really they haven't gone way down after September. They just have meandered after this, after September.
Yeah, and their year-to-date performance is still pretty good. So I just overall, I mean, I don't own any tech stocks. I don't really dabble in that, but I just see the way they performed, and I look at just the narrative around the digital transformation and the narrative around stimulus. I just see them as a a good barometer of where we are and where we could be going.
Do you follow much of the biotech stocks? Because obviously Buffett did add to some of these ones, I guess. Like NBI. Do you follow anything like that?
I follow the Nasdaq Biotech Index on a general, more generally. I know it's much more volatile, but you take a look at how it's performed, and it really has in a lot of ways mirrored the Nasdaq since the March flash crash. So I see biotech still, a lot more choppy than the Nasdaq in general, but they've been going up as well.
Yeah, the ones that people have really plowed back into are like the ones that were beaten down, like your energy sector and your financials, to name two right off the bat. And they do pay good dividends on a lot of these guys. So, I mean, they're still well off their highs for the 52-week. Is there a big opportunity still in energy and the financials, or is this just really a snapback rally that'll go into the fade mode?
Energy, I'm not so sure I would I would put long-term bets on energy, just given the state of that market and just the state of a lot of the more macroeconomic transitions that we're seeing. You take a look at the financials. I think in a low-rate environment that could be an issue, but I think that in a market where you have stimulus, I think that there's going to be a lot more opportunities, and I would definitely see more opportunity in the financials than I would in the energy stocks right now.
With regards to volatility, is it a situation where you use a vehicle to play volatility, or are you just using that as an indicator?
We use it as an indicator. We also use vehicles. There's different ETNs in the volatility market that we use. One of them is also the SEXY, which kind of bets on declining volatility. If there's any bullish bets on stocks, the SEXY is usually a good play because it moves in the opposite direction of volatility, but at a faster pace. So if you're betting on a bull market in stocks, and that's what you're seeing reflected in the VIX, the SEXY is one tool that we use. Yeah.
Yeah, because with regards to the overseas markets, are you looking at anything international? Because they've started to get a little bit of a bid, and some people tell us that the valuations over in Europe and Asia are much better than, and emerging markets are much better than here.
Yeah, I look at it more broadly. I follow the main indexes in Europe and in Asia, and look at the performance on a monthly basis. You take a look at what's going on, especially in Europe. We've seen some huge gains over the past month, but nothing. I don't follow them as in depthly as the U.S. market. But in general, things seem to be on the up and up globally right now.
When you're looking at a stock like BABA, obviously it went from $180 up to 320, a heck of a move. Then the Ant deal got squashed by the party over there, and it sent this thing down about 250 something. It's at 260 something. I mean, it is a mammoth story. Do you think there's a value between 200 or 220 and 260 that's worth looking at? Because
I think so, because BABA has a lot more value than just that deal going through. So I just look at it again from a macro perspective. A company like Alibaba will have long-term value regardless of what happens with this particular deal. But Alibaba is one of those companies that I think as this transition to a digital economy continues, and as we rebound from the COVID crisis, I think BABA is going to be one stock that performs well.
The three things that hit me right now is the S&P 3700, the VIX around 20, and the dollar index at about 90 and change. And it all hits me as the trifecta that something's got to give. In other words, if 3700 gives, boom, 3800 probably in the cards. If 20 gives, maybe 15 on the VIX is in the cards. And if the 90 doesn't hold, maybe 85 on the dollar index. But the other side of the coin, because you've been in it a long time and so have I, there's got to be another argument because it's a two-sided trade, right? So the other argument would be is that the dollar is at a low and positioning is extremely negative. It's that the VIX has come down to rock bottom and the enthusiasm at 3,700 is extremely high, which says that positioning is very short the dollar, very long the stock market, and very short the VIX. And if positioning is very heavy in one direction, sometimes you have to give a little bit of credence to the concept that it could go the other way just through profit taking or, rebalancing or whatever. So, this dollar index at around 90 and change, how do you feel about it?
Yeah, I think that's a really good point. When it comes to the dollar, again, for me, when I look at it from a macro perspective, I really do see the dollar going lower next year. I just see everything from stimulus to the economy. I just feel the dollar, 2021 could be a really bad year for the dollar. Now, if we are going to look at the other side of the position and we want to look at, the VIX, for example, as I mentioned earlier, one area of concern that could, stifle my bull market argument is the fact that the VIX remains elevated compared to historical averages when you look at the S&P being at record highs. So the fact that we've touched multiple record highs in the S&P, yet the VIX is still around 20 to 25, that would be one source of concern, because last time the S&P was at record highs in the early part of the year or last year, we saw the VIX much lower. So that's one area that I would be looking at, the sense that we do have above average volatility. Considering that we are at record highs, that's one area that is concerning.
And do you follow any of the other different commodities, like the agricultural commodities or anything like that?
Mostly just the energy sector is what we follow, yeah. Not really much the agriculture, yeah.
Yeah, that natural gas is a wild one lately, huh? Back and forth, back and forth.
Yeah.
Is that
And
almost too? Is that almost too volatile to trade? But maybe a stock like LNG might be worthwhile to take a look at.
yeah, exposure to the stock market, I think, is a much more reliable bet because you're betting on the, with the stimulus in the stock market. I think that's a more reliable bet, given just the volatility in general around oil and natural gas right now.
Now, the strongest thing, and this is what somebody made a note of this that I thought was interesting, is that if the Qs make new highs, but the SMH doesn't make new highs, that was the tell last time that the move is over, and that's not been happening. So on SMH, which is your semis, NVIDIA, Advanced Micro Devices, those kind of guys, Taiwan Semi, they just made a 52-week high today. So are you still, are you watching the semiconductor index at all, or what do you think?
I haven't been following it lately. No, I do follow NVIDIA just in general, but I haven't been, privy to the more recent movements. No, I haven't.
Yeah, because again, I think that some people are looking at that as a very positive sign in that I guess the last time there was a major turn, it stopped going up before the Nasdaq did. And that was your kind of a little bit of a tell. One stock that's gone nuts, and I was wondering if you did anything on, is Tesla. I mean, they're going into the Dow Jones or the S&P, I'm sorry, on December 21, and people are running into it like it's water in the desert and it's the last canteen in town. We're at 629, up $30 today. I mean, the thing has just been parabolic, and we saw with Apple, they bid it up to about 140 because it was splitting. And then they did basic math and figured out that that doesn't really matter that much. And then it fell apart down to 103. 140 down to 103 is a good size drop.
Yeah.
Do you see the potential of Tesla as we get closer to this December 21 to possibly run out of steam here with these buyers who think that that is going to be an event of an event?
Yeah. I mean, if you would have asked me, 4 months ago, did I think Tesla ran out of steam, I would have said yes. But then look at how it's performed. I just think that too many people are drawn into the idea that there's a strong narrative around Tesla, and I just think that as long as that narrative is alive, people will continue to bid up Tesla stock. So they will be in the. I didn't hear that they're going to be in the S&P. I guess that means they had their consecutive quarters of profitability. Is that what it was that got them in the S&P? Because I think they were rejected earlier in the year, weren't they?
Yeah, no, they meet the criterion, but again, they were even actually talking about only putting half of it in because it's so expensive. You know what I mean?
Yeah.
But anyway, I'm looking at a 200-day average on Tesla at 284, and I'm looking at a stock at 630. And I'm looking at a situation where common sense would tell you that it's getting awfully far away from shore here. Do you ever use the long-term moving averages and the price as any kind of a gauge on how far away into la la land you are? Or?
Yeah, absolutely. And what we're seeing with Tesla with that, differentiator is, as you mentioned, the animal spirits. It kind of defies the, conventional technical analysis. I don't know where Tesla goes from here, but I do know that people are buying into the narrative that Tesla is going to be, the emerging dominant player in this, new paradigm of autonomous vehicles and, battery fuel technology. So if that narrative plays out, I guess, if we do have this global transition away from, fossil fuels and towards driverless cars and towards autonomous vehicles, there could be an argument that at some point in the future, Tesla will grow into these valuations. I guess that's what they're saying. But looking at it purely from a trading perspective, and where the company is now with respect to revenue and sales and things like that, it's completely bonkers.
We are going to be going into this 5G thing, and the three stocks that I've been very keen on have been Broadcom, AVGO, Qualcomm, QCOM, and T-Mobile. And I just was wondering if you had any feelings on this 5G phenomenon that's supposedly coming.
Well, I don't follow it as closely. I don't really follow those stocks as closely, but 5G is another one of those major emerging technology trends that they've been talking about for a long time now. So if they succeed in this rollout and the technology is adopted, I think that any company that has primary exposure to that technology is going to do really well. Just like there's a lot of different technology paradigms that kind of feed into those types of moves, especially like data analytics, AI. There are so many different emerging technologies that kind of fuel those narratives, and 5G is one of them. But I haven't followed those stocks. No.
Yeah, they seem to be getting a lot of bid. The ones that are losing some of the altitude here are the COVID stocks, as you say, like Zoom and Teladoc and some other companies like that. Do you feel that because the vaccine's coming, because we're closer to re-entry into the whole thing, that the Zooms and the Teladocs and the others, may have a difficult time when we come out the other side, or?
Yeah, I mean, I think that what this COVID crisis did was it really solidified the importance of these companies. So I do think that they're going to play a big role moving forward. I just think that they're probably overextended, and as things kind of get back to normal, you will see them back off from these valuations. But looking at it from a macro perspective, I do see this new paradigm of work from home as being something permanent. So I think that these types of stocks will continue to perform well, and they're not going to have the same uptrend that we saw, back in the spring. But I do think that there's going to be a permanent place for these types of companies to grow into some of these valuations that they've had.
I'm looking at the Qs today because, you did say that you follow the Qs quite a bit. And we did hit an all-time high again today on that, 307.63. So is that something that, do you have any kind of a target where you think it might go? And do you think it'll, have any volatility here in the near run?
I don't have a specific target, but I mean, with the Qs and with the Nasdaq, you always have a lot of volatility, and I expect that to continue. To what extent that's going to be remains to be seen. But looking at it more broadly, I do see tech stocks continuing to move in the uptrend, and I think we're going to have that reflected in the Nasdaq throughout the year.
On the S&P versus the Nasdaq, do you think, because it's been a total outperformer, the Nasdaq, obviously the Qs, they made a high when they broke above 220. They took out their 52-week high back in June. And so they've gone where from, that's 60 points, they've gone 33% above their 52-week high. And the former 52-week high on the S&P was 3,400. So yeah. You'd have to go to 4,500 on the S&P to have a similar move to what you saw, in the Qs. So, I mean, do you think it's a situation where looking forward, the S&P may at least do as well or even better than the Qs? Or do you think? Yeah.
I just think the Nasdaq is a perennial outperformer. I mean, even if you take a look at it year to date, it's up over 39%, which is more than double what the S&P has gained. I just think that, as I mentioned earlier, within the sphere of technology, within the sphere of stocks, technology is the fastest horse in the race, and I don't expect that to change. To be honest, I think the S&P is going to do well, but I think the Nasdaq will do even better.
And you're pretty satisfied with Biden coming in and Yellen being in there, and pretty much because the credit markets, obviously, that's another thing that we haven't spoken about. Yields have been rising. Can you see yields accelerating next year a bit to the upside, and then the bonds obviously going down?
Well, they could. I mean, that's certainly possible. I just think that with new stimulus coming and with Yellen, given her track record of stimulus, I just think that it's going to feed into a more risk sentiment. I don't necessarily agree with that direction. I think that the big issue that people should be concerned about is inflation and the devaluation of the dollar, which I think is going to be a major issue moving forward, especially when you look at asset price inflation. They like to justify a lot of these different stimulus programs by telling us that inflation is too low, based on a very narrow metric called the CPI, which is kind of ridiculous. So I just, if I'm just being honest, I just see this fueling, another stock market rally. Not necessarily that I agree with this direction, but as long as you have that stimulus coming, I just see that the risk sentiment is going to be higher, and investors aren't going to be looking for that meager yield in the bonds. They're going to be looking for more substantial gains in stocks.
Yeah, let's look at TLT up here because that's the proxy for the 20-year Treasury, and it seemed like it was teetering around this 155 area. And if we had a longer-term graph on it, I was wondering if we could see what TLT looks like on a more of a weekly basis going back further. Yeah, if we were to get TLT, I guess should be in the, I don't know what that 110% is. TLT. Yeah, I know the chart doesn't look like the price. Anyway, do you follow TLT at all? Because that is the proxy for the 20-year. And
I haven't. No, I haven't followed the TLT.
Yeah, because it's a proxy for the 20-year Treasury, and it peaked out at like 180, 190 when we were panicking back in March because rates dropped so far. So it was kind of a blow off top, and they've been trading more like. Yeah, I don't know why this machine's not doing it. But anyway, it's been holding on to like the 155, 156 range.
I can't get it to switch back to the numbers. It's still showing the comparison percentage, but there's nothing. I turned off the comparison, so I don't know.
All right. Well, that's as good as we get. Anyway, it was just something to talk about from the standpoint of interest rates, because, the interest rate picture in the short run, the Fed can control the short end of the curve, but generally the duration, the longer term stuff, is more open to the market perspective. And the market perspective, as we're talking about, people are thinking the gold may go up 2,000, 2,500 because of, dollar weakness and inflation. You're talking about the stock market possibly having a very good year and earnings going up dramatically. And that is all pretty powerful stuff. And then consumer spending, which is 2/3 of economic growth, going crazy. So you would imagine that might have an effect on a 20-year bond that's trying to get away with paying people 1% and change, right?
Absolutely.
So I mean, there you go. There's the price of it now. You can see the blow off here up around 172 was even higher, I guess. Yeah, because this is only going back to June. So the high really was like 180, 190 on this thing, and then you can see that the trend has been down because obviously people realize that interest rate is a joke. I mean, imagine paying people at 1% interest and you don't have to give their principal back until 2040.
Who's making these trades? Who's buying these? I don't know.
I don't know.
I don't know.
It's crazy, but it's like I was wondering who would be buying negative interest in Europe, and the guy buying negative interest in Europe is betting it's going to get more negative. And if it gets more negative, you can actually make profit by buying negative bonds. So it's a crazy environment, like you say, and that's why the gauges that we talk about, like the Buffett gauge, GDP into the Wilshire 5000, temporarily here, certainly looks like it just can't be used because we've got an artificial situation going on.
Well, they say time is money, right? I guess with negative rates, time is no longer money, right? I guess.
Right. Yeah, exactly. Well, I was wondering, because we've covered quite a bit here today, is there anything else that you wanted to bring to the table, that you've been focused on that I haven't covered at all, or you haven't covered through the questioning?
No, you let me ramble on about cryptocurrency, which is always a joy for me. So I got away with that. Otherwise, the volatility markets is what we're following closely, and the S&P. And as a macro guy, I do look at the big picture and look at fundamental analysis and where the market is headed. And I think we covered off quite a bit of stuff.
Yeah. On the crypto, I mentioned the GBTC. Is there any other vehicles that you kind of look at for that?
The GBTC, that's the main one. I know there's some, crypto futures, Bitcoin futures, but mostly I look at the spot price on Bitcoin because I do see a lot of, direct buying on the wallets and placing in the wallet. So I mostly follow the spot price of Bitcoin as well as GBTC, and those are pretty good gauges of where the market is headed. If you want to know where the market's going to go, look at what Bitcoin is doing, and that's reflected in the GBTC as well.
This Russell 2000 has made a new high finally. Its high was made in 2018 during that prelude to the big sell-off. And so it took a long time to get that Russell to a new high, and it did it in the last month or two. And so is there a lot more legs to small caps with the Russell? Because that's an interesting thing, because it's made a new high, but it's not 9 miles past it like the tech is.
Yeah, I mean, you probably know more about the small caps than I do.
Yeah.
I don't follow them as as closely, but I was a bit surprised seeing how long it took for it to get back to record highs. That did surprise me.
Yeah, that and the transports, they both peaked out in 2018 and took all the way till just the recent past to make a new high. And of course, with e-commerce, FedEx, UPS, the railroads, everything else, they're cooking pretty good because, people need to get stuff delivered. All this e-commerce doesn't come to your house with a magic wand.
Hmm. Hmm.
So that's why that's done very well. Well, yeah, as far if you have nothing else that we can cover here, I was wondering if you could explain how people could get a hold of you, and then also how you might have any special offers for them that they could take advantage of.
Sure. Well, if you want to learn more about volatility, and you want to learn about trading volatility as an asset, as well as trading weekly options on various markets, you can visit us at TradingGods.net. We do have a retirement day trader program available that can teach you how to sell weekly options on a consistent basis. We also have a VIX trader program that teaches you all the ropes on how to become a volatility trader in the options and in the futures, as well as in the ETN market. So all that is available at TradingGods.net, and we look forward to seeing you there.
Yeah, you bet. And it's very good talking to you today. And I'm going to, for people who'd like to get my weekly newsletter, simply go to optionprofessor.com and then put in your email. And then it is free of charge. So we do send out a weekly update that covers everything from the stock market to the oil, the bonds, currency, et cetera. So that's how you can keep in touch with optionprofessor.com. All right. Nice talking to you always, and hopefully you'll be back soon so we can update things after we have more information, maybe right after the first of the year. You could give us your new year situations that you have. And David, I'm going to send it back to you right now. Thanks a lot for being here, and thanks everybody for attending.
Yeah, actually, Sam will be back next week, right?
Yes.
Oh, really?
Yeah.
Great.
So we can catch up with them again next week. So
Perfect.
all right. Yeah, thanks, guys. Lots of good info covered today. So just a quick reminder for everyone listening, be sure to subscribe to Timing Research on YouTube and your favorite podcast app or directory. And you can also go to TimingResearch.com, and you'll see the archive of today's episode as soon as I can get it posted. And you can also catch up on any of the past episodes or presentations that you haven't had a chance to look at yet. So I just want to thank my guests again for today, Sam Bourgi of TradingGods.net and the Option Professor of OptionProfessor.com. Thanks, everyone.
Thanks, David.
Thanks a lot, guys. Thank you.